With US-China trade talks heating up and major earnings and inflation data on the way, global markets are bracing for a pivotal week ahead. Joining me here at the desk is Rodda from Capital.com. It's been a big one already.
It's been a huge one already, and it's probably going to be even bigger next week. So, I mean, as you noted just off the top there, earnings, interest rate decisions, we've even got trade talks next week with the US and China, and what seems now a meeting between Xi and President Trump. So it's going to be pretty huge and could potentially define the path forward for markets for the rest of the year.
Yes, they'll be watching closely to see what comes, particularly when it comes to trade. Which parts of trade do you think? Is it the minerals the most?
That's the important leverage point that the Chinese have, and what the US will be trying to negotiate the Chinese to back away from. And I think there is a degree of confidence, especially last night, that will occur. I mean, you don't set up a meeting between your two leaders, you know, if you think there's something's going to fail.
Yep.
So the US is going to want to see that, you know, effectively that's removed. It's been strongly argued in the first place that, you know, the Chinese have kind of made these threats to try and get the US focused back on trade once again, and it was really just a bit of brinkmanship. But then, of course, as well, you know, in the last couple of days, the US has threatened technology export curbs as well, as you know, and there was a sort of 100% tariffs flagged a few weeks ago too. So really, you know, no one's expecting there to be sort of a kumbaya and a complete resolution to obviously the trade issue between the US and China. But if they can get confirmation that those things are taken off the table and we return to some sort of status quo, that would be great for markets.
They're both coming to this meeting like divorced parties, basically, with something on each other. For the United States, they've put a huge trade barrier onto China. For China, they've looked at minerals, as we've mentioned. We've now seen tech. It's a tit for tat that we have. Is the trump card for China, for Trump rather, Australia, and the meeting with Anthony Albanese that was this week, which was essentially the minerals, which was the big thing that China has done to the US ahead of this meeting? Yeah,
I mean, it is a very critical part, I suppose, pun intended. Obviously, the US...
You finance guys have a bit of a sense of humour, don't you?
Don't we? Yeah. It won't. The deal between the US and Australia won't be enough to effectively fill the gap in potential supply from China, and so it's a little bit of a piecemeal response, albeit a very, very important one. But effectively, you know, at least for now, the United States is going to want to be able to diversify its supply chains. It's going to probably want to be able to establish its own capacity one way or another to extract rare earths. And, you know, one thing about rare earths is it's actually a bit of a misnomer. They're not necessarily rare, it's just the production of them is very uncommon, and China is very big. Good at it, and well, for a variety of reasons. Anyway, the US wants to basically decouple from China on this critical issue. The deal between the US and Australia is a part of that, but they're still going to be very interested to make sure in the immediate term China backs off these curves, because, you know, there's no simple solution to cover that gap if China follows through with those threats.
Okay, what does success look like? And success is a tricky one because it's subjective. Success for Trump, success for Xi Jinping, success for the markets. What do you see as success looking like?
For the markets, success realistically is effectively these threats being backed away from, and then again we return to the status quo of, you know, two strategic powers or global powers in a strategic battle. That's inevitable. It's not going to go anywhere. Investors will accept that, but they want to get rid of this uncertainty of, you know, basically the Chinese nuclear option, and then, you know, the 100% tariffs that the United States has threatened China with. For the US, I think, and China, you know, China backing away from these rare earth export curbs, the Trump administration can tout success. China can say that if they get closer to a trade deal because of this brinkmanship, they would tout that as success as well. But I think critically, the strategic battle between the US and China isn't going anywhere. It's sort of, you know, Thucydides trap sort of situation. It's just a part of the structure of the world economy and global politics right now. But if things can come off the boil a little bit and return to where we were about a month ago, I think everyone can tout that as a success.
Kyle, I'd imagine the story on Monday will be the reaction to inflation data for the US. What are we expecting? We've seen, obviously, the past few months, a bit of a seesaw.
Yeah, well, we're expecting 3.1% for a core inflation figure, which is steady for the month earlier. And it has to be said, these numbers were, of course, delayed by the government shutdown, but they've been, you know, forced to be released because of some indexation that the BLS has to provide the government for tax payments. But it's coming out. It's a little bit delayed, slightly old news, but again, steady inflation rate, core inflation rate of 3.1%, and a steady inflation rate on a month-on-month over basis of 0.3%. The markets are pricing in very, very aggressive rate cuts going forward from the US Federal Reserve, partly because the Fed has said that it's willing to look through inflation spikes, because a lot of it is expected to be because of tariffs and the slow pass-through of tariffs, but that's a one-off kind of thing. The concern is that we were already seeing sticky inflation and above target inflation, that there are persistent risks to the upside to inflation, and markets are still pricing in aggressive rate cuts. So it's a big assumption. So if it comes in a little spicy tonight, next week's Fed decision is almost a lock for a 25 basis point move, but we're looking at a federal funds rate that the markets are pricing in for next year at less than 3%. If anything shakes that up, that's going to be where the volatility comes into things.
Gosh, it is going to be a big week ahead. Talk to us a bit more about the Fed Reserve.
25 basis points basically priced in. Again, it's just this very dovish outlook being baked into the rates curve, which is, partially because there is a deterioration in the labour market, but also there is the expectation that, the Fed is either ignoring its inflation side of the mandate or is willing to take risks that this sort of one-off lift in prices or tariffs will result in a one-off lift in prices, and that inflation will eventually moderate over time. That's a really big assumption. Arguably one of the reasons why we have seen things like stocks and even gold rally over the last few weeks is that, basically the Fed is willing to tolerate inflation well above target and more or less forego that side of their mandate. So given that 25 is baked in, it's very unlikely not to go 25. It's about that guidance going forward. Are the markets on the money with the very aggressive rate cuts being baked in, or is the Fed more cautious and wary of inflation than markets are giving them credit for?
What about the impact to Australia? Talk to us about the Fed rate cut. What does it do to the Australian dollar, the local market here?
Well, it's because it's already baked in and we've got aggressive cuts already baked in. You might say that the risk is a little bit asymmetric, which is to say that the US dollar is already discounted that there will be all of these interest rate cuts, and if we don't get those, then the Aussie dollar would have to appreciate as a result. So the same thing for equities, the same thing for, again, gold prices, that the bar is set really, really high for the Fed when it comes to trying to exceed these dovish expectations. I suspect, based on recent form, the Fed won't want to say anything too definitive and be rather non-committal, not support pricing by suggesting that, yes, these cuts are actually coming, but not give any kind of information to force them to be priced out. Again, it's a risk because, with cuts already priced into the market, that means that policy easing is already having an effect on economic activity, which could, again, accelerate inflation. But the Fed wants optionality. There is, of course, too, the issue of Fed independence and who's going to be the leader of the Fed next year as well. So, really you're only going to look at the next 6 months as being kind of relevant as far as forward guidance. But again, once more, I don't think the Fed is going to want to support these cuts, or at least the pricing of these cuts, but they're not going to do anything to try and water it down. And I think as a result, it's an upside surprise. It really shakes the markets if they don't do that.
It's an extraordinary time. Talk to us about Australia's own inflation data, what we're expecting here, because inflation, again, has been seesawing, but we're starting to see unemployment go up. Yeah. What would it look like if unemployment's going up and so is inflation?
Well, it's stagflation, and that's the worst thing in the world for economists and market participants, because it's generally defined by weak earnings growth, weak growth, from a macroeconomic standpoint.
That's the ship taking on too much water.
Yeah, and obviously, interest rates that can't come down to support, the weak demand. So it doesn't look like we're necessarily in stagflationary conditions. And, one thing that the labour market data did show last week, which was weaker than expected, that some of that spare capacity is building in the labour market. So it's unlikely we'll see kind of wage pressures coming through and having a wage price spiral. But the markets have shifted their focus again to the weakening labour market in Australia, taking their focus away from obviously the inflation side of things, which had garnered more attention with some of the CPI indicator reports that we got through August and September that were suggesting things were moving away from where the RBA wants them to be. The counter-argument against that was because of basically the end of energy subsidies. So there's a hope that that will be quite temporary. Mm-hmm. But if we get this data out next week and it suggests that inflation is above where the RBA projected it would be in its previous statement on monetary policy, then that says that the cuts that the markets are baking in will have to get priced out, and that's when things get a little volatile as well.
And just quickly, we've got about a minute left. Investors, how's sentiment there?
Neutral right now, and this is kind of a very
waiting and watching.
So we've basically got US stocks just below record highs, Australian stocks just below record highs. They want a catalyst to be able to buy in again. It could be earnings, it could be a dovish Fed. In the short term, immediate term, de-escalation between the US and China trade tensions, they would all be the catalysts. But if they go sour, maybe things break to the downside.
All right, big week ahead. Appreciate your time as always. Rodda, Capital.com. Thank you.
Thanks.